Home buyers Q&A. Ask any question that you want about home ownership, and I'm answering today. I actually have some questions that were asked to me in advance. I'm not sure if the people will be on or won't be on, but we're going to try to get their questions answered. So here we go. Hi, I'm Kevin Jefferson, and I'm going to answer your questions today on home ownership, whatever questions you have. So, one of the biggest questions that I get from people, actually, the person asked me, why do you need my bank statements? Great question. We need your bank statements because we need to see a few things. We need to see your direct deposit from your pay, and we need to see that you have enough money in the bank to qualify to pay for your down payment or closing costs. While I'm getting help with my down payment and closing costs, we also need to see if you have insufficient funds, any large deposits that came in that did not have to do with your pay, and where you got those payments from. So those are all things that we need to see when we usually look at your bank statements. So I have another question that says, hey, can I add a co-signer to my loan? In the mortgage world, it's considered a co-borrower. That means the person is going on the loan and they will be a borrower along with you. What that means is that person has the same responsibility as you, right? So part two of the question is, can they use just their credit, their income, and not their credit? The answer is no. If a person is co-borrowing with you or co-signing with you, their credit and income and assets have to be verified the same as you. So I always explain to the person, if you're late, they're late. If you're on time, they're on time. They have the same responsibilities. No, they don't have to live in the house particularly, but they do have the responsibility of ownership. So if the home gets foreclosed on or the bank comes after you for funds, they're coming after that co-borrower as well for their funds. Next question is, can I get a gift when purchasing a home? Yes, you may. The gift has to be from a verifiable source. We, as the lender, provide a gift letter. The letter has to be signed from the person who is gifting the funds, as well as the person who is receiving the funds. We need their bank account number, the name of their bank, and we need the relationship of them to you. Okay? So you can receive a gift from someone to purchase a home. I want to go a step further because it typically happens or is asked. Can I receive a gift and down payment assistance and ask the seller for closing cost assistance? The answer is yes. But depending on what your score is, you still may not get approved. So let me tell you why. Every time you get some type of assistance or funds that do not belong to you, every time you get funds or assistance that do not belong to you, it's considered a level of risk. So what that means is, a level of risk is if you get down payment assistance, that's one level of risk. If you get seller's assistance, that's two levels of risk. So we're adding layers of risk onto the file because the funds, less and less funds are coming from you. If you get a gift, That's the third level of risk. So what that means to you is I'm getting a house, I have the credit, I qualify. However, I'm not putting much of my money into this deal. So what FHA typically says is, and they feel like from statistics, the less money you put into a deal, the more apt you are to either walk away from the deal in terms of if the house you're behind on payments, or you potentially don't have the ability to save money because you don't have any money saved or into the deal. Now, if you have assets, meaning money in your account, but you're just using different sources in order to qualify or to for your closing costs, then that's very well possible and it could help you. They would consider that something called reserves. So again, you could potentially get down payment assistance with seller's assistance and a gift from a family member. Right now, the way this market is going, they've tightened up and it's become tougher, but depending on your score, it's still possible. My next question that is asked of me is, how long do I have to stay in this house once I buy it before I can turn it into a rental? If you are using down payment assistance, you typically need to stay in there. I've seen the periods as short as 3 years, and I've seen as long as 20. And the reason why they do that is because they are giving you funds and they want you to, your intent to stay and for it not to be a rental property. Now, if you go traditional FHA and you have your own down payment, your closing costs is portion paid by the seller, or you have your own closing costs, minimum requirement to stay FHA, VA, USDA conventional, 1 year, 1 calendar year, 12 months. So it is possible to only stay in the house for 1 year and move. But if you have down payment assistance, there's going to be an additional requirement for the time frame. Today, I had a person ask me, can I qualify for the no credit score FHA loan if I have a credit score? And the answer is no. I see why they asked that question, but it's for people who do not actually have credit scores. It's not because you don't want to use your credit score. It's because the person doesn't have one. So if there's an FHA program where you do not need to have a credit score. Not that you don't use your credit, you don't actually have one. When I go pull credit, Mr. Bob Jones actually has a non-scorable credit score. He or she doesn't have anything. He doesn't have anything if it's Bob Jones. Now, if we have someone who we pull their credit and their credit score is a 650, a 550, and they have a lot of lates and they don't want to use their credit, then that's not an option for the no credit score FHA loan. The next question is, I have money and I have a low credit score, can I get qualified? And the answer could be yes. It depends on what type of assets you have. So when a lender is looking at a person's ability to qualify, what we're looking at is your credit score, your income, and your money. And I always refer to it as assets because it's not necessarily just money in the bank. It could be 401k, IRA, some type of annuity. That's possible. So with that, you have to have at least 2 of the 3 going in your favor. If you have a low credit score and you have, good income as well as good, money in the bank or good assets, then you're more likely to get pre-approved, right? Or approved. If you have a good score and money, but not good debt, you still could potentially get approved. However, it just all depends on how much you can qualify for. Now, if you come and you've got bad credit, no money, and low income or a lot of debt, then the likelihood of you getting approved at this point is going to be very difficult because you're showing that you're not a viable partner. So when I talk to a client, I say we are looking to partner with someone when you're buying a house. We're looking at, is this person someone I want to partner with? If we're doing FHA, you're bringing 3.5%, we're bringing 96.5%. On a $200,000 house, you're bringing $7,000, we're bringing $193,000. Is this person somebody I want to partner with, and are they going to pay me back, and how they're going to pay me back? That's the questions that we ask. While I'm doing this, if you're just joining my live, I'm answering questions on home ownership. Whatever you have to ask, I'll answer it to the best of my ability. If I don't know the answer, I will get you the answer. But I want to make sure I take this time and answer any questions that you guys have pertaining to the market, programs, home ownership, refinancing. Hey, I even think I will answer some questions on investments if you guys have questions. So we have a question right now. I think I'm ready to see how much I can get approved for. So my link will be below for you to get approved. You can also set up an appointment to get on my calendar to ask specific questions that are specific to your needs. So I would definitely be answering questions, and we can stay on here for a while. I had a question. USDA loans, do you know how long the process takes? I submitted an application with Guild Mortgage back in March and still waiting for the underwriter to come back with the terms. So that depends on where you're at. Is it in pre-approval stage that they haven't gotten back to you? Everybody varies. Our turn times are typically 48 to 72 hours. If you went to the underwriter with Guild Mortgage and they haven't gotten back to you, then I would reach out to your loan officer and say, hey, when do you think I'll hear something? Now, if you're under contract, you've been underwritten by Guild Mortgage, that loan application, after it's been approved through Guild Mortgage, has to go to USDA and get an approval from their underwriters. Typically, but USDA depends on their workload. I've seen as long as 15 days, and I've seen as short as 72 hours. So that all depends on where you're at in the stages of getting, whether you're getting pre-approved for TBD, or if you are getting approved through the lender and they actually had to submit it to USDA for their final approval. So hopefully I answered that question with love to Tamara. T. Maria. Yeah, if you want your questions answered, whatever it is, you can drop it in the chat wherever you are. And I'll continue to move on with additional questions that I get or have. So another question that I get all the time, why can't you take screenshots? No. So the question is, if you can't take screenshots, how do I get my documents over to you? We're in a society where it's easy to screenshot things, but underwriters typically don't accept that. They want it in the form of a PDF, as well as they want it in the form of it could be scanned and emailed, or it could be faxed over. Screenshots are not sufficient. And when I say screenshots, I'm talking about screenshots from your phone, as well as you pulling your bank statements or pay stubs on your computer screen and taking a picture of the screen. Which leads to my next thing is we can't take pictures either. We don't take pictures. It's once you take a picture and it's uploaded to the system, say we turn it into a PDF, it's no longer as legible as it is before. You submit it to the underwriter. Underwriters looks at tons of files a day, and they don't want to guess. They want to be able to see it and be able to move through the file smoothly. So no pictures, no screenshots, PDFs, or faxes. That's how we can accept the documents. Hey guys, if you're just joining my live, do me a huge favor and drop your questions in the chat. If you have questions pertaining to home ownership, whether you're in the process now with somebody else or you're looking to get in the process, drop your questions in the chat and I will do my best to answer those questions for you. So a lot of times I have clients say, when I submit my bank statements, which bank statements do you want? We want the bank statements that show your direct deposits. We want the bank statements that show where your funds to close. If it is in a checking or savings, provide both. So some people get a portion of their check direct deposit into a savings, and then they get their rest of their check deposit into their checking. Provide both statements so we can see that you have the funds to close. The biggest thing is when we ask for bank statements, you can't cut out or black out the account number. The underwriter and we want to see that it is your account and that the account numbers match up. So when we get the wire or the attorney's office get the wire when you go to closing, that it is in fact the right account and the account where the funds are coming from. Which leads to another question. Can I bring a check to closing? Typically, no. For large sums of money, they want them wired directly to the attorney's office. So what will happen is when you get your clear to close and you get your cash to close, they will send you wiring instructions. You take those wiring instructions. Now, listen to this. This is key because there's a lot of wire fraud going on. When you receive an email from the attorney's office with wiring instructions, call the attorney's office and make sure they sent you the email, right? When you wire the funds, make sure the attorney's office received your wire because you want to make sure that the wire went to the right place. And you also want to make sure that it was the attorney's office who sent the wire instructions. If the wire, if it seems suspicious, pick up and call. I advise you to pick up and make that phone call because once it's wired, if it's wired to somewhere that it wasn't the right place, it's going to be very difficult to get that wire back, if darn near impossible. So when you wire your funds, make sure that the email came from the attorney's office, and you want to make sure after you wire the funds that the attorney has received the wire so the funds are there. Now, in case, let's take example that your closing cost was $12,000, that you received was $12,500. And for some reason at the last minute after you wired your fund, it ended up being $13,000. When you get to closing, the attorney's office typically, most of them typically will take a personal check for like $500. Anything over that or maybe $1,000, they typically don't. And there's a couple of reasons. The person could write the personal check, and this came from attorneys office told me, they've had people write personal checks at the closing table and then stop payment on the check after they've closed on the home. So then they're short. The mortgage company is short, the attorney's short of getting the funds, and then technically, if the money isn't there, you don't own the home. So to stop not wire fraud, but stop people from doing stop payments on large checks, they stop accepting accepting checks for large amounts. In some smaller markets, I've seen them be able to bring a cashier's check, but that's certified. So the money is already taken out of the person's account and it's good to go. So that's a better bet. But most attorneys' offices now are accepting wires. It's faster. It may cost the borrower a couple extra dollars, depending on what the wiring fee is for your bank. However, it is a safe way to get your funds to closing. You're not bringing a duffel bag or brown paper bag to closing, the Nike shoebox, holding the stash, if you know what I'm saying. You just want to make sure that you wire it ahead of time. You confirm the wire before you wire it, and make sure that the attorney's office received your wire. That's the safest way, because there's a ton of wire fraud. If you are enjoying this live, or you know someone who is looking to purchase a home or may have questions, do me a huge favor and share this live out and give me a thumbs up. It would be greatly appreciated with these algorithms. Awesome. So now we're going to talk about additional things that clients ask all the time. So I got a question. What is Click and Close program? So Click and Close is a down payment assistance program that participates in all 50 states. Your lender has to be an approved lender with Click and Close. Sometimes you will hear it referred to as Smart Buy. What they do is they pay 3.5% of the down payment on FHA loans. They do not have any income limits. They don't have a housing price limit except for whatever the FHA housing limit is in your area or your county. With Click and Close, there's a couple different options. So you have a 5-year forgivable. You have a 5-year forgivable program where if you stay in the house for 120 months, you're not past 90 days late at any one time. Let's say they gave you $14,000 on a $400,000 house. That $14,000 after the 5th year is forgiven, meaning you don't have to pay it back. The caveat to that is you're typically going to have a higher than market interest rate, and you're going to have discount points that you have to pay. So a discount point is equivalent to 1% of the loan amount. So if you have 3 discount points on a $300,000 house, that's $9,000 that you have to bring in addition to your closing costs. So with down payment assistance, there's discount points that are charged. So sometimes it doesn't make sense to utilize, and sometimes it does. With Click and Close, a minimum credit score of 620. You can have a non-occupant co-borrower. You can use it if you're buying a new construction home. What you can't do, it can't be used on multifamily yet. Right now, it's for single family only. Hopefully, I answered your question. So just to add a little bit more, they do have additional options if you hear about them, where they have a 10-year repayable option, which means you have a second mortgage. And it is paid interest only on the amount that they gave you. So you could pay 9% on the $14,000 that they gave you. So then you have a first and second payment. So what's the difference between the two? The forgivable has higher discount points than the repayable. So it depends on the person. Do you want to pay more out of pocket up front, or do you want to have pay less out of pocket and have a higher payment? To me, I would go at the 5-year forgivable, higher payment, but after 5 years, forgiven. No problem, Demaya. I'm glad you reached out to me. Glad you reached out to me. So with the click and close forgivable, repayable, it's for 10 years. You're paying interest only for 10 years. And after that 10-year period of time, you need to, your loan, that portion of the loan is forgiven, right? However, I want to be clear. You can pay it off at any time with no prepayment penalty. So example, let's say you do the 10-year repayable. And then once you pay off that amount of the loan, then you protect, it's done. So they take the second lien off. You no longer have a second mortgage. You've got a new interest rate and new servicer. So hopefully that answers your questions about click and close. Are tiny homes considered single family homes? In most cases, yes. But it depends on what type of tiny home. Some of the tiny homes that are economical, where you may be in one of those tiny home communities where you got solar energy or wind energy and different things as such, they could be, but you also could run into a issue with square footage, the square footage of the property. Demaya, did you say this program is in every state? Yes, it is in every state. Click and close is available in all 50 states. Third degree burns, I would be curious to see what size those tiny homes are. Yeah, I would be curious to see what size the tiny homes are, and we can see if we can get it qualified for an FHA mortgage or for traditional mortgage. I'm sorry. All right. So, guys, if you're watching this live, do me a favor, drop your questions in, whether you're in the process of purchasing a home, or you are looking to get in the process and you have questions pertaining to home ownership. I will be answering your questions. Hello, talk about Chenoa Fund Program. Thank you, Ms. Smith. So Chenoa is a down payment assistance program that is available in 46 or 47 states. They're very similar to Click and Close. They pay 3.5% for the down payment. They do have a program that pays 5%. However, to me right now, the pricing doesn't make sense, right? So Chenoa pays 3.5% of the down payment. They have slightly higher than market interest rates. On that loan, they have discount points. Minimum credit score is 600. You can maximize your debt to income ratio up to 56.99 if you get an AUS approval for that. Chenoa has a 3-year forgivable program. So if you are purchasing Chenoa and you're using the forgivable program, they will forgive your loan after 36 months of on-time payments, no more than 130-day late. Anything more than 130-day late, your 36 months starts back over. They also offer a 10-year repayable, very similar to Click and Close, which allows for you to get less discount points. However, you would pay interest only on that second. So let's take that same $14,000. And if your rate on the first is 7.25, the rate on that second, on that $14,000 will be 9.25. So it's always going to be 2% points higher of an interest rate than what your first is. So what that does, it creates you having a first and a second. You pay less out of pocket using that, but you have a longer period of time that you have to be in a house or before you can refinance or sell without paying back the money, as well as you'd be coming out of less, but you'd have a higher monthly payment because you've got two loans. So hopefully that answers that question on Chenoa. Chenoa, like I said, 600 credit score with Chenoa. You could do a duplex. So you can buy a 1 to 2 family. You live in one side, and on the other side, you rent out the property. So Chenoa allows you to purchase a duplex. Click and Close only allows you to purchase a single family home. Yes, I do lend in Texas. I do lend in Texas. It says, do conventional or FHA loans generally work better for down payment assistance programs? Are lenders able to run numbers between the two types of loans? So that's a great question, Demaya. Yes, lenders should be able to run scenarios between the two types of loans, whether it's FHA or conventional. Sometimes some loans don't qualify for both. Sometimes it's and maybe not both. So for instance, the two down payment assistance programs I just discussed, Click and Close and Chenoa, right now they only work with FHA financing. So conventional is not an option. Here in Georgia, you've got Georgia Dream, where it works with FHA, VA, and USDA and conventional. The caveat to the conventional is they don't want you to have mortgage insurance, so you have to put 20% down. So if you're going to put 20% down on a conventional loan on a $200,000 house, that's $40,000. You don't need down payment assistance if you got 40 grand to put down on the house. And then that 20%, the $40,000 is over their asset limit. So it just depends on the program, what programs they work with. But yes, a lender can run either scenario, whether it's conventional, FHA. I mean, you can run conventional with 3, 5, 10, 20% down versus FHA. So a lender has the ability to run those. Now, I will say that even though they have the ability to run those scenarios, it is not a quick process because they have to take information out, change the program in the system, put another program back in. So it's just not clicking a button in order for them to show you or see what you can qualify for. So give your lender some grace because it takes time to run those different scenarios. It says, I know this depends on the county, but can I apply for a homestead within a month of buying a house and keep the last assessed value of the house the previous owner had? Typically, counties and states have their own homestead exemption period of time. In Georgia, it's from January the 1st to sometime in May. So each time has a different time frame. Yeah. Like, we would love to have the other owners tax liability, but they may have had an exemption because they're a senior and they don't have to pay school taxes. So it varies, but it's possible. But the next month, no, not unless you close in December and then you file for the homestead exemption in January. Good evening. What are typically the total average costs of closing costs? That's a great question. So I hear a lot of different answers, right? I hear people say it should be 2%, it should be 3.5%, it should be 1%. The answer is going to vary. So let me give you an example. In Delaware, they have transfer taxes that you pay. You pay 4% transfer tax, 2% paid by the buyer, 2% paid by the seller. So if it's 2% of the sales price. So if it's 2% of the sales price, that's already 2% of closing costs you have to pay. So that 2% rule doesn't go in. You still have your attorney's fees. You still have your taxes. You still have your year of insurance. So let's take Georgia for example. Georgia doesn't have a large transfer tax. They have a tangible tax, but not a large transfer tax, right? So on that same $200,000 house, closing costs could typically be anywhere from, if the seller's not paying anything and it's straight you, anywhere from 9 to 12 grand. Because remember, right now in this market, you have discount points. Discount points is 1% of the sales price. So if you got discount points in Georgia and or Delaware, the Delaware closing costs is going to be higher. If you're not a first-time home buyer, Delaware's closing costs on that same $200,000 house is going to be higher because of the additional fees versus Georgia. So I don't really have a rule of thumb. The best thing I tell clients to do is to send it to me, let me look at it, and I can give you a guesstimation. Because it even gets even deeper. Let's take Georgia. And let's say you're in one county, let's say you're in Gwinnett County. Gwinnett County has higher taxes than Hall County, which is our neighboring county. On a $200,000 house, using the same lender, let's say the same score, same person and everything, the closing cost is going to be higher in Gwinnett County than it is Hall. I would say all encompassed, I say maybe 4 or 5%. And somebody may say, oh, well, you crazy, but it's the truth, because taxes, you don't know how high the person's insurance is. It's parts in middle Georgia where insurance is a lot higher than it is in the metro Atlanta area, because they're further away from fire stations and further away from fire hydrants. So if a fire truck has to go to that house, they're going to have to go further in distance, and they're also going to have a longer hose because they're further away from a fire hydrant. So all of those things play a part in your down payment and closing costs. I know that was a long-winded answer, but hopefully that answers your question. So, hey guys, I am answering questions pertaining to home buying, whether you're in the home buying journey or looking to start the home buying journey. I'm here to answer any questions that you may have in accordance to purchasing a home. So another question I get all the time is, should I talk to the realtor first or the lender? The lender. Now, if you see a house on 123 Main Street and you go to a realtor, they'll talk to you, but I'm pretty sure they're not going to show you a house unless you have a piece of paper saying that you're pre-approved or conditionally approved. Heck, not even just a piece of paper. If it says pre-qualification, a lot of the good real estate agents I know say this is not worth the paper it's written on. So they want you to get a pre-approval letter. So when you're in the process, talk to the lender first so you have some money and hey, Mr. or Mrs. Realtor, I'm pre-approved for $300,000. I want to be in this area. I'm looking for 4 bedrooms, 3 bath, 4 bedrooms, 3 bath, yada, yada. And then they can help better advise you on what you're looking for. But if you're just shooting out in the dark and you say, oh, I don't know what I'm qualified for, but this is what I want, you're probably not going to get an agent to show you the house that you want to take a look at. They might tell you to go some open houses or maybe to some new construction sites where they don't have to take you. But it's going to be tough to get somebody to show you a house if you don't know what you qualify for. Ouch, I wasn't expecting it to be so high. That's just a guesstimation. Again, it's tough. It's tough for a lender to answer it. Which goes to another thing. I've just heard it. I put out a video last week about it, and I heard it this week. Matter of fact, I seen it this week. I was beat out on a deal by another lender for a buyer. The numbers that I gave them were estimates on, the estimates on the taxes and insurance were high because we don't know what those are, right? I included discount points as well. The lender did not include discount points and they gave them a super low rate. I had a friend who works at the company that the pre-approval came from along with the fee sheet. And I asked him to price out the scenario for me. It was a $280,000 house. The lender did not put discount points on the fee sheet. Remember, it is 1% of the loan amount. When he priced it out, that person needed to bring an additional $8,500, which was not disclosed to him. So if you're a buyer and you're going to go look at multiple lenders, you need to look at the sheets and compare apples to apples and oranges to oranges. Some lenders are giving fee sheets without all the accurate fees. I see it a lot from Rocket Mortgage, Navy Fed, Veterans United, and not to bash those companies because they're particularly good companies. But if they don't know the local market and they don't know the fees, or they don't have the accurate information, they're not going to give you an accurate number. I would rather say, hey, Miss Borrower, I need you to have $20,000 available. And then when it's time for the numbers, you only need 15, then they tell you need 15 and you really need 20. That's how I like to do it because it's hard to come up with additional $5,000. It was probably hard to get that 15. So getting an extra 5, now you got to borrow. It could affect when closing is. So if you're going to shop lenders, make sure you're not just hearing, oh, they're giving me a low price for closing costs and they're giving me a low interest rate. You need to make sure that those numbers are accurate and ask, okay, why is this mortgage company giving me the same rate but charging me points, and why don't I see points on yours? That's just a little heads up. What does a higher credit score help with? Is it just looking more favorable to get a loan? Seems like in today's market, prices and interest rates are just high no matter what. Higher credit score does help you get approved, shows that you're creditworthy. In this market, it could help you not pay as much in discount points. It could potentially help you have a much lower interest rate. But markets are cyclical, right? I know people say, well, historic lows, when my mother purchased her home, I think she said her interest rate was like 20%. Granted, the house was what, $25,000, $30,000. That's different, right? However, inflation, housing prices have increased, interest rates are increased, but you got to be thankful that interest rates don't rise with inflation as much as people would think they do. Not necessarily we're at historical lows in terms of interest rates, but we're at historical interest rates. When I got into the business in 2004, rates were hovering around somewhere near 8. Then they got down to 7. And when they got to 6%, people thought they were stealing money. This was 2004. The market was on a upward movement, and housing prices were very expensive. But again, my comeback to interest rates are high. If you're renting and your rent is $1,000, you're paying $1,000. You're paying 1,000% interest rate because you get no benefit to renting other than you got a place to lay your head. Hopefully that answered your question, Ms. Demaya. Hey guys, again, if you are watching the replay on YouTube, do me a huge favor, give me a thumbs up, drop your question in the chat. If you are watching it live and you just jumped on, we are answering all of your home buyers questions, whether you're in the process, starting the process, want to get into the process, we're answering whatever questions you have about home ownership. Question that I get a lot: can I stack down payment assistance programs? And the answer is yes and no. The answer is yes and no because some programs will allow for you to stack programs, right? However, the no is going to be some don't. And if that program does allow for you to stack, some lenders don't want to because it's a lot of extra work. It's a lot of extra work for them, and it could affect the closing costs. So it sounds great that you can put DPA 1 and DPA 2 down together, and instead of you having, $15,000, you got $25,000 for down payment and closing costs. It takes a special lender who wants to do that. So, you can potentially stack them, but good luck finding a lender who's willing to do that. Again, with the approval part, that brings on another layer of risk. So it's not as easy as it would seem or sounds. Yes, I lend in Florida. I can help you lend in Florida. If you get a fixer upper, are you able to take the extra money that you're approved for to make home improvements, or do you have to get a separate loan? That is a great question. If you get a fixer upper, you're going to utilize a FHA 203K or potentially a Fannie Mae home style, which is a conventional rehab loan. They are done differently. Their interest rates are typically a little bit higher. You typically have to have your own money for down payment and closing costs. The down payment remains the same, whatever percentage it is. The closing cost is typically a little higher, simply because there's a couple extra steps involved. I want to say this. While it's hard to find some lenders to do fixer uppers, it's even harder to find a contractor to do fixer uppers because the contractors get paid after they've done some of the work. And what I found with fixer uppers and rehab loans is if the buyer isn't given the proper expectations and time limits up front, they're going to be very, very frustrated through the process because there's a lot of extra steps. So to answer your question, if you got approved for $300,000, the house that you purchased was $200,000, can you get the extra $50,000 and use for repairs? If you do a renovation loan, yes. If you do traditional FHA, conventional VA, USDA, no. All right. And while we're at it, there are renovation loans for FHA, VA, USDA, and conventional loans. Talk to your local lender about it. And if they don't participate, give me a call. This is a great question. Who does the closing costs go to? Everybody. There's typically a underwriting and processing fee for the lender that goes to the lender. If there are discount points, that goes to the lender as well. The homeowner's insurance goes to the homeowner's insurance company, State Farm, Allstate, Country Financial, Liberty Mutual, Progressive. If you have city taxes, the city taxes go to the municipality or the city. The county taxes go to that county. There's attorney's fees. The attorney's fees go to the attorney's office. The title fees for searching the title goes to the title company. If there's something called carrier fees or recordation fees, the carrier fees are for it to be overnighted or shipped to you or shipped to wherever it needs to go. The recordation fees is what the county or the city charges to have those documents, the deeds or the satisfaction notice, recorded in the county, because all those are fees. So whatever down payment, whatever you put down, that goes to the seller. So closing costs is where everybody gets paid. Everybody gets paid. The down payment goes to pay down on the house. The closing costs goes to closing on the home, all the fees and everybody else who is involved in the process. That was a great question. Are your origination fees competitive compared to other lenders? So we have processing and underwriting fee. We don't have an origination fee right now. We have discount points. Our discount points are competitive. You may find a lender. I'm going to say this. We're not the cheapest out there, but I'm one of the most skilled out there. And I'll bet on that. I put my money on being one of the most skilled loan officers out there. So sometimes you pay for what you get. I've had people who went to a prime example. Somebody went to Rocket Mortgage. They had a lower rate than me and they couldn't do the loan. My rate was higher, but I got the loan closed in their homeowners. So sometimes you get what you pay for sometimes. And a lot of these low ball companies are closing or getting brought out. And not that we're trying to gouge anybody. It's just skill level and what it costs for our company to provide a great service. But yeah, Derek, we're competitive. We're competitive, man. So, hey guys, I am talking about home ownership, answering all of your home ownership questions pertaining to homes, down payment assistance programs, FHA, VA, USDA, whatever questions you have, do me a huge favor and drop them in the chat. Demai, you might have had the most questions today. I might have to give you a prize. If you're in a DPA, does it still make sense to shop lenders even if the interest rates will generally be the same? I've heard that these loans are more expensive due to the funds granted. That's true. The down payment assistance is nothing wrong with it. But if they're giving you money and you don't have to pay it back, there has to be some type of charge to it in order for them to continue to fund that deal. So do I want to get $20,000 and pay $30 to $40 or $100 extra a month when I don't have $20,000? I'm going to take that any day, right? If I can qualify for it. Does it make sense to shop lenders? Yeah, you can shop them. All lenders don't have the same requirements, but when it comes to down payment assistance, they control the guidelines, not the lender. So the lender doesn't control what they can do for the down payment assistance. The down payment assistance program has a set of guidelines and rules that we have to go by in order to qualify you. So if you go to lender A and you're looking for this down payment assistance, and you go to lender B and you're looking for the same down payment assistance, you're going to get the same interest rate, most likely the same discount points. Thank you, Deshauna. Same discount points and the same amount. So unless that lender has a different down payment assistance program, I would say stay where you are. Your service are good so far. Thank you, my friend. I've got one of my current clients on here. That's good to know. Do I do USDA? Yes, I do. I do USDA. I think it's a great program. Has a lot of positives. It's a great opportunity for someone to get into a home with no down payment. So if you're listening and you don't know what USDA is, it is not the stamp that's on your state label. It is the United States Department of Agriculture, which has a housing program called rural development. Rural development is where it has to be in a specific portion of your county or town. The property has to be eligible as well as you for USDA. It is 100% financing, meaning you have no down payment. However, you do need to bring closing costs. Minimum credit score typically is 640, and the seller has the ability to give you up to 6% closing cost assistance. The downside to USDA is the debt to income ratio limits are very low. So you have to either have a decent income and low debt in order to qualify for a decent amount of home in this market. It is good only for first time home buyers, and you cannot utilize it for multifamily. Hopefully that answers your question. What's the minimum amount FHA lends on their loans? That is an excellent question. So FHA does not have a minimal amount that they lend. However, lenders have minimal amounts that they lend on loans. The reason why some lenders won't do loans under a certain point is simply because it's not cost effective for them. The same, I'll be honest with you. Typically on lower loan amounts, it is more work than higher loan amounts. So, if you're using the same manpower or more energy to close on a $85,000 house as opposed to closing on a $385,000 house, you're putting out the same processor gets paid the same, the underwriter gets paid the same, the loan officer gets paid the same, the staff gets paid the same, and you may lose money doing $85,000 loans. So that's why some lenders don't do small loan amounts because it just doesn't make financial sense to them. But in terms of FHA, there is no minimum. If you're pre-approved for a loan amount that's smaller than you need, but are able to make changes to lower your DTI drastically, how fast are you able to receive a new letter with a higher amount? Depends on the lender. Could be 24 to 48 hours, could be 72. It just depends on your lender. What is a homestead and what is the benefit? So homestead is where you apply for a homestead tax exemption. And what it'll do, it'll help keep your taxes from going up. So it's a benefit of keeping your taxes lower. Hopefully that answers your question. So there is some benefit to it. Not significant amount in terms of taxes increasing. However, every dollar counts. Which actually goes into another question. Why did my mortgage payment go up this year if my loan is fixed? So if your mortgage payment, when you get it go up, there's two things that we can't control: taxes and insurance. Insurance companies have rate hikes, every couple of years, sometimes once a year, sometimes twice a year. Just depends on what's going on in the market. Taxes typically increase. Right now, the way the market's going on a yearly basis. So those are ways that your mortgage payment will go up. The principal and interest, if you got a 30-year fix, 15-year fix, or 20-year fix, that's not going to increase. The principal is not going to change other than going down. That payment's going to remain the same. If there's an increase in your payment, typically it's because your taxes and insurance went up. If your taxes went up, it's not much you can do about it. Your insurance goes up, I would shop and see if I can get a lower insurance rate. That could help your payment go back down. Hopefully that answered your question. Is the 640 for everybody that's going to be on the loan or the main applicant? Great question. So when there's multiple people on a loan, we take the lower of the middle scores. So what the middle score is exactly the middle. If you got a 670, 660, and 650, 650 is the score in between 670 and 650. It's not an average of the three. It's not if it's Experian or TransUnion or Equifax. It's for everybody on all loans, it's the middle score, the one in between, so they can be conservative. If you have two people, one person's middle score is 660, the other one 620. If it's an FHA loan, they are going to base the interest rate off of the 620. If it's a conventional loan, there's going to be some calculation in terms of them adding it, and the lower score is going to be balanced out with the higher score, but the interest rate is going to be based off of the 620 as well. Hopefully that answered your question. It says, what's the number one reason you've seen a loan fail during the underwriting process? The number one reason is probably the borrower doesn't have any money or have enough money. The number two reason is when we do the verification of employment. If a thorough verification of employment is not done up front, that could create hiccups. What's a verification of employment? It's when we get your bank statements to see that you still have your job and how much you get deposited in, right? We look at your gross on your pay stubs and make sure the net matches the net that's on there. That's one way to verify it. We get 30 days most recent pay stubs. Then when you're under contract, we do something as you'll hear referred to as a VOE, verification of employment. Now, if the pay stubs you have been getting show you working 40 hours a week, that's one thing. But if we reach out to the employer and they say, this buyer typically only works 32 hours a pay period, even though your pay stubs say 40, and it says sometimes says they're only guaranteed 32 hours, we have to go at the most conservative income. So sometimes it's nothing we can do, because I asked the borrower, do you normally work 40 hours a week? And they say yes. Are you guaranteed 40 hours a week? Sometimes they was like, they're yes, and it's really no. Because even though you've been there consistently working 40 hours a week, and you may not even remember when you worked less than 40, if the employer says you're guaranteed 32, we have to go off of what the verification of employment says, unless we can get them to break it down and show that you work more and explain why you're working more and only guaranteed 32. So hopefully that answered your question. Top reason, person don't have the money. Number two, person doesn't have the income. Number three, they go out and buy something or run up the credit cards and the scores drop. Those are my top three. All right, guys, I'm going to take one last question. So it is going to be Eunice. A husband and a wife, can one spouse use their credit and the other use their income to get approved on their loan? No matter. In order to qualify, we need to have both credit and income for both borrowers, right? Now, let's reverse the roles. Let's say the husband doesn't work, but he has a good score and low debt. The wife has a decent score and she's got the income. Even though he may not have the income, but he has the higher score, that could help you get approved. If I've added borrowers with no income but had high scores to make a stronger credit profile for the person with the income. It just all depends, but in terms of using their one person's credit and one person's income, it's not going to be used just those things. But if one has a better score and the other one have better income, they could help offset where the other one lacks, if that makes sense. AJM, this is my last question. What if employer says I work more than my pay stubs say? Then we're going to go with it's a good question. So we're probably going to see if we can use the income or the hours that the employer says, and we'll have to do something called a letter of explanation as to why you're not working the 40 hours like you're supposed to. Sometimes there's reasons. Sometimes it's because you just have taken off a few days or you left early. For whatever reason, I've seen people who've had to leave work early or multiple times because they've had physical therapy or something going on. So if we can get a letter of explanation as to why you hadn't been working those hours, then we may be able to use it. But if you're supposed to work 40 hours a week and you haven't worked 40 hours a week in 4 months and you don't have a reason, then we're going to go at the most conservative income. All right. What if you're retired and on a fixed income? Yep. We can use retired income. We can use retirement income, Social Security, disability, child support, W-2 income, 1099 income, alimony, annuities, pension. We can use a lot of different incomes to qualify a person. Guys, this has been great. If you've enjoyed this or you thought this was very informative, do me a huge favor. Give me a thumbs up. If you're watching the replay and you have a question, please drop it in the comments. I check my comments. If you are interested in booking a call with me, reach out to me. My contact information will be below and schedule a call. I appreciate you guys. Thank you and have a great night.